Most investors that we've spoken to recently are negative, but maybe not to the extent of the editor of the Gloom, Boom, and Doom report. We're talking, of course, about Marc Faber. He is concerned about valuations across the world in a number of different asset classes, but there are some areas that he likes. Marc in the United States, in Chicago, on a trip, and we appreciate it. It's nice to have times kind of linked up with you, Marc. Usually you're in Asia or in Europe, and it's hard to link up. We appreciate you joining us. Let's first talk about the overall world right now. I think we can put that decoupling theory to rest. How concerned are you still about a U.S. slowdown? Because certain parts of the market, according to you, are already predicting a recession. And if we go down, is the whole world going down with us?
Well, first of all, I think that if statistics were measured properly in the United States, the U.S. would already be in a recession and would have been already so for a couple of months. And I think that if the U.S. goes into recession, it may not be a total disaster for the rest of the world, except that in the rest of the world, we also had colossal bubbles in property prices, in commercial construction, and we have a global boom. So I would suspect that after a global boom, and don't forget the expansion began in 2001 in November, so we're already in the 75th month of the expansion now, that this will lead one day to a global bust. Moreover, I doubt that the financial markets will be decoupled because we have this very close connectivity. So when the S&P goes down, other markets also go down, some more, some less than the US.
Okay, you mentioned that we had 75 months of boom. You're talking gloom, but let's talk about the other side, the doom. Psychologists have proven that the pain of loss is generally greater than an equal gain. You lose $100, you feel worse than if you gain $100. So that said, you said these colossal market increases, is the pain of the hit going to be a lot more severe than the joy of the ride up?
Yeah, I suppose so. And also the losses are very significant. If you look at the loss in market capitalization, the loss in the dollar. And I have to point out, in the US, they pursue essentially economic policies that target consumption, which in my opinion is misguided. What they should pursue is economic policies that stimulate capital investment and capital formation. And if you look at, say, the monetary policies, we started in the US to cut interest rates very aggressively on September 17th. And we cut the Fed fund rate from 5.25% to 3%. And what is the result? I tell you what the result is. The stock market since September 17th by the S&P is down 10%. The US dollar is down 10%. Gold and oil are up 40%. Well done, Mr. Bernanke.
Are we already maybe in the middle of the doom part of it? Or do you think that equity prices have a lot further to fall?
Well, you have to ask Mr. Bernanke, because if he prints money, and I have to add here one point, had I been the professor who would have judged his thesis for his PhD, I would not have let him pass. I would have told him, actually, Mr. Bernanke, I give you one condition under which I let you pass, and this is that you never join a central bank, because you are a destroyer of money's store of value function, of the function of money being a unit of account. The only central bank that I would allow you to go to is the one under Mr. Mugabe in Zimbabwe. And I tell you that Mr. Bernanke, with his monetary policies, he will destroy the US dollar.
Well, listen, okay, I'm going to defend Ben Bernanke a little bit if I can to play devil's advocate on this. The dollar was in decline before Bernanke took over, not to the extent, but it was still in decline. We already had historically low interest rates. When he took over, we had historically low interest rates. Doesn't he need to at least ease monetary policy to get us out of this funk? Because if you look back at what he studied in the Great Depression, lack of flexibility of monetary policy was part of the conclusion as to why we had such a prolonged downturn.
You are also following the economic sophism of Mr. Bernanke. The depression occurred not because the central bank was tight when the depression started, but because it was far too easy in its monetary policies in the period leading to the depression. namely between 1925 and 1929. And I'm not blaming Mr. Bernanke only. Mr. Greenspan, his accomplice, is also to blame, because what they did after 2001 is to push the Fed fund rate down to 1%. Keep it at 1% until June 2004, when the economic expansion began in November 2001. So they kept monetary policies far too easy, and this led to reckless lending, to reckless credit growth that caused the problems that we have today.
What would you do then? If you're going to be critical of Ben Bernanke, then what should we do? Raise interest rates, deflate the asset bubble of gold and commodities, which have made a lot of people a lot of money, and try to stabilize the U.S. dollar. Is that the right course of action?
Yes, but I would have done this a long time ago, and I would not have cut the Fed fund rate from 6.5% on January 3rd, 2001, down to 1%, and then leave it at 1% until June 2004, and then increase it in baby steps. I would look at monetary policies and focus not on core inflation, because nobody in this world lives without energy and without food, and certainly nobody on Wall Street, and certainly nobody at Bloomberg. And so I would not just look at core inflation, but I would pay attention to asset bubbles. And the Fed has created a gigantic asset bubble, a credit bubble, and now the credit bubble is deflating, and it will be very difficult for the Fed to reignite the credit bubble, because we are in a process of deleveraging. The way, as they increased interest rates between 2004 and 2006, the way lending standards were eased at that time and didn't lead to tight money, now, as the Fed cuts interest rates and Mr. Bernanke may go to zero, the lending standards are tightened, and so the private sector is tightening credit conditions, not the Fed.
All right, we know what's happened. Let's talk about what we do. I know from your latest Gloom, Boom, and Doom report, reading it, you called the bond investments, basically Treasuries, financial suicide. We had a guest on earlier who said you're getting a negative real return when you factor in actual inflation as well. So I would assume you're completely avoiding almost every fixed income instrument?
Well, I think that at some stage the corporate bond market will offer some value, but the Treasury market, say the 10 years and the 30 years, is a disaster waiting to happen. I think that there we are already in a period where the Fed can maybe cut interest rates on the short end to 0% on the Fed fund rate, but the bond market will tank at some point, because inflation is, of course, much higher than what the bond market is yielding at.
Well, it's like the point we made with our Bloomberg reporter, Mark, and you know this better than I do. At some point, there's a buyer for everything. Are you waiting for yields to get higher on investment grade or even high yield corporate debt before recommending that that's where we need to go? Or are we just, even with spreads widening, we're not getting compensated enough for the risk?
Well, I think that there's some corporate bonds, and I'm not a credit analyst in the United States, but I suppose that a very smart credit analyst today that is good at analyzing balance sheets can find in the junk bond area bonds that will continue to pay, where the companies will survive, and that will reward the investor. And in fact, the argument for stocks is frequently that you take, say, the earnings yield on the stock market and you compare it to the bond yield, and then people compare it to treasury bonds. But I think you should take the earnings yield of equities and compare it to, say, the typical S&P company, and that is a yield that corresponds, say, to triple Bs. And so basically, as of today, maybe some bonds are more attractive than equities.
Let's talk about equities, though, because you yourself in your latest report pointed out that the last time we had bearishness among investors at this level and people predicting doom and gloom on the earnings side, that data shows that stocks have actually done relatively well. Do you think they will? I mean, is there a way to recover from this? Because the financials and the home builders, as you've noted yourself, are basically already predicting a recession.
Yes, that for sure. But I think some home builders could still go bankrupt. But the point I wanted to make in my report is this. Over the last, say, 4 or 5 years, US stocks have grossly underperformed other markets in the world, like emerging markets or the commodity markets. And so on a relative basis, I think today emerging markets are more vulnerable than the US, say. If you look at India or China, these markets could easily drop 30, 40% here, whereas the US, with the money printer we have, will take the deflation rather through a dollar depreciation than through asset price declines in nominal terms in US dollars. You understand what I mean? Is theoretically, the dollar could go lower, as it has over the last few years, as you pointed out. By the way, in euro terms, the S&P today celebrates the anniversary that it is down 50% from the peak in year 2000. So it's a wonderful day.
Yeah, and not for us to go to Europe, I can tell you that much. Maybe it's good for
yes,
US.
Yes.
Maybe it's great for U.S. exporters. You know, what do we do then? I mean, you know, a lot of these commodity markets, I know you like them, sugar and other things, they've gotten so expensive. And when you see gains of 300% and 400% over a couple of years, don't you have to look back and say, you know what, I just missed it. It's too late. Or is it not too late?
I disagree with you. I disagree with you. First of all, when commodities started to rally in 99 to 2000, and not all of them bottomed out at the same time, they were at the lowest level, inflation adjusted, or in real terms, in the 200 years history of capitalism. So they started out from a very low level. Gold was at that time, as an example, around $255, down from $850 in 1980. Now, I admit that the $850 in 1980 was too high. But say today the price of gold is, say, up a little bit below 1,000. So we've gone up 4 times. But you look at the gold bull market, 1970 to 1980, it rose from $35 an ounce to $850 an ounce.
You know, Mark,
so we were
Mark,
up
I want to continue
times.
this. I got to go to a commercial break. Got to catch our breath a little bit. We're going to bring you back, all right? Marc Faber is going to be back with us right after the break. We'll continue our discussion and his feelings on Asia. Stick around. I'd like to continue our discussion now with Marc Faber, editor of the Gloom, Boom, and Doom Report. He is joining us from our bureaus in Chicago. Okay, so we talked about some of your feelings on gold, and you're saying it's not too late to get into some of the commodity markets, right? Specifically, it sounds like gold still, sugar, what else?
Well, I mean, you take as an example sugar, and it's moved up recently a little bit, but sugar peaked out in 1973 at 70 cents a pound. And then we went down to 2.5 cents a pound in 1986. And now we went up 2 years ago to 20 cents a pound, and now we're at around 14 cents a pound. Well, inflation adjusted, this is a very low price. Actually, I think that sugar is one of the cheapest commodities, inflation adjusted, in the universe of commodities.
All right, I'm going to ask you about something else. You mentioned home builders. I want to go back to equities quickly. Are we going to see a major, I'm not talking about a regional or a mid-cap, are we going to see a multi-billion-dollar bank in the United States fail?
I hope so.
You hope so?
Yes, of course. That is the only way to introduce some discipline in the financial system of the United States. Because if you bail out each bank all the time, you create tremendous moral hazard and you perpetuate the mistakes that the Fed has already done. It is to be hoped that one major financial institution goes bust.
You think it's going to be Citigroup?
Well, first of all, there is something called too big to fail, so it will be bailed out. But I don't know. I mean, we have to look at the banks which have the largest derivatives exposure, because that is the next time bomb to explode at some point.
You don't think it's exploded already?
No,
the credit markets
the
and the derivatives markets and CDOs, CDSs, SIVs, SUVs, everything else.
These are structured products, but the derivatives, they haven't exploded yet. That is now the main course that will then happen in the next 3 to 6 months.
And can complete your sunny disposition, you believe that we're not going to see the bottom in equities until names like Google, RIM, and Apple go 50% from their highs, correct?
Yes, at least or more, ideally more. Because what happens in a bear market, first, you have one sector that falls, and this has been obviously the home building sector after the summer of 2005. And then the Goldilocks crowd will tell you everything is wonderful, and it's only one sector specific, and stocks go down, but the industry is sound, as Mr. Bernanke also repeatedly said, and then the subprime lenders start to fade. That again, according to Goldilocks, is only one sector of the financial industry and so forth. And so the bear market has to mature like a good cheese or a good wine.
And you're the biggest bear that wants to eat Goldilocks, I think, Mark. But we appreciate you coming on. Marc Faber, we never even talked about Cambodia. He likes Cambodia. We'll get the other side on the stock market with Bob Olstein. About a half an hour, you're watching Final Word. We're back.